PNC delivering an earnings beat, but narrower top-line miss in their Q1 results. The company reaffirming that it isn't seeing any meaningful impacts from the broader volatility in financials over the last month. Joining us here to talk about that and more at the New York Stock Exchange in a CNBC exclusive is PNC CEO Bill Demchak. Bill, it's great to have you. Welcome.
It's good to be here.
So what is your level of concern? Because we got the results and the stock sold off most of the day, finished higher. How should we interpret it?
My level of concern is not much. I mean, remember last time I spoke with you, we said, what's the year going to be about? It's going to be about credit and liquidity and deposit flows. Back in January, we talked about that. The deposit flows and costs of deposits are more than we thought. So we ended up trading up, but we revised our guidance down. By the way, it looks like everybody who's reporting today is doing the same because of higher net interest costs. But, we projected towards what I think will be a record year for us. Positive operating leverage, an otherwise good story. So not much to complain about, just not as great as it could have been.
What's changed, though, obviously, is the failure of 3 banks in this country and a whole re-examination by the market and potentially the regulators of the regional bank model.
You have to stop with the regional bank model. There's really big banks, there's tiny little banks,
regional.
There's none of the above. Like what happened with the banks that failed has nothing to do with their size or how they were, these were state chartered banks that were chasing a shiny new object that doubled or quadrupled in size in a couple years, that had management that wasn't up to the task of running a larger institution, that grew that fast, and the regulators missed it. Right? That doesn't matter if they're small or they're gigantic or regional or otherwise. They screwed up, and regulators didn't catch us. It just wasn't our finest moment. But, this presumption that somehow, a smaller bank is going to be more at risk. You guys call us a regional bank. Just as an aside, we're national coast to coast. And by the way, we would be the 5th largest bank in the world, the #1 largest bank in the U.S. in the year 2000, given our size. So you have to get some context on how big is big and the safety and soundness of the 99% of the banking system, which is great, and a handful of characters who, frankly, did the country a disservice.
But what I think the focus on regionals, first of all, wake-up call for uninsured deposits, wake-up call for unrealized losses on the balance sheet, wake-up call for banks that aren't regulated as much as the systemically important banks.
Yeah, but now you're, when we'll get there, right, there's going to be more regulation that rolls downhill. By the way, there probably should be. I'm not sure that anything that's on the books today in terms of stress tests would have caught some of the banks that failed. I mean, they failed the old-fashioned way on basic interest rate risk that hopefully you learned your first year in business school. But that's fine. They'll roll regulation down. More people be subjected to it, and maybe that'll give people comfort. But, the context of how these guys got in trouble relative to a normal bank that's otherwise in the business of banking, growing at GDP plus a couple % a year, it's just different. It's got nothing to do with small or large.